Now we're ready to look at the financial statements when we're talking about our accounting sequence in the order of the basic steps. Let me review that. The 7 basic steps of accounting. We have our T accounts and our journal entries. You can do these either or, 1 or 2. Some people prefer to do journal entries, then do post them, or first do posting and then do the journal entries. At any point along the process, if you're ever asked or need to, you can always prepare a regular trial balance. And then when you get to the end of your reporting period, whether it be in the end of the month, end of the quarter, or year end, we will want to look at our adjusting and or correcting journal entries. Now, correcting entries you would want to do whenever you found a mistake, but this is just where I put them to have somewhere to have it. The adjusting and correcting entries. When we're all done with our adjusting entries, we can then prepare a final adjusted trial balance. It's called the adjusted trial balance because it does contain all of our adjustments that were needed. As we did in the previous video, we looked at the closing entries and the post-closing trial balance. Now we're ready to look at the final step, which are the financial statements. The financial statements are the only item in this 7-step process that would ever be seen by anyone outside the company. All of these other items are seen strictly within the company. You would never just give out a trial balance to an outside vendor like a bank or the government usually. You're going to send them the final financial statements. And so therefore the financial statements are a little bit more condensed in some instances. For example, like with accounts receivables, I like to keep them separate on the trial balance so I know who owes me what, especially if there's not that many. But on the financial statements, we will go ahead and combine items like accounts receivable because it's nobody else's business who owes us money. The only thing that matters is that somebody does owe me money. So we'll see that when we get to an example a little further down. So here's here's 3 of the 4, I should say, financial statements. We'll look at the 4th one at the very end of the semester. It's the statement of cash flows. But the 3 that we're going to look at right now, as you'll see in a second, we have to always do these in the correct order. You can't skip order because a piece of each one of these goes into the next one. So the first item, the first financial statement we do is the income statement. The income statement contains all of our 400 and 500 accounts, the revenue and expenses. Basically, it's just a summary of how much money did I make. And if that sounds familiar, well, it should be because that's what we just did with closing entries. When we closed up our income summary, it was a summary just in T account form of our basic earnings for the year. On the income statement, instead of calling it the income summary, we call it net income, which you'll see me abbreviate NI. The second statement is our statement of retained earnings. All this is basically a summary of the retained earnings T account. We start with our beginning retained earnings as our T account would. We then add in our net income, which also happened when we were doing the closing entries, when we added in the income summary closing, when we closed out income summary. And then we take away any drawings. We closed out our drawings. Same thing happens here. And we get our ending retained earnings balance. It's a very, very simple financial statement, but it is important to always have an updated retained earnings. The final statement that we're going to look at this week is the balance sheet. And the balance sheet has every other account. We have all of our assets, and then basically it's the equation. All of your assets better equal your liabilities and your owner's equity. Now your owner's equity will no longer include your drawings because your drawings have already been used, and they will not include your beginning retained earnings, but instead they include the new ending retained earnings. So therefore, when I say you have to do these in the correct order, because you cannot do the balance sheet until you know your ending retained earnings. And your ending retained earnings comes from your statement of retained earnings. And you can't do your statement of retained earnings until you have your net income. Your net income comes from the income statement. And the final thing I wanted to mention here is as you're going through, look at the trial balance, the adjusted trial balance, and know that every account gets used just one time. Okay? So as you're going through, check off the revenue and expenses when you're done with the income statement. And you'll know that you don't have to put those on any other statements. Do the same with drawings and your retained earnings balance, your beginning retained earnings. That is only used one time. And then all the rest go to our balance sheet. Our balance sheet contains all the remaining what are called permanent accounts. They're permanent because remember these guys up here are the temporary ones that we did in our closing entries. Okay, we're ready to look at our example. Again, I'm going to pull up the Dr. K that we did with the closing entries. So here's the adjusted trial balance again. It's always good to start with our adjusted trial balance for both the financials and the closing entries. The first item we do is our income statement. Remember I said that's our 400 and 500 accounts. That's our revenue and expenses. And the numbers that we get to when we're all done should mirror what our closing entries were for this statement and the next one, statement of retained earnings. So let's look at an example of the income statement. A couple things to keep in mind when we're doing an income statement. The first, you always need to have a proper title. A proper title always has the company name at the top. There we go. Company name at the top. What it is we're preparing. In this case, it's the income statement. And then the time period for which you're covering. And you'll notice here the two words as of. As of means for this year only, which should make sense because revenue and my expenses are only this year amounts. I don't have revenue listing of $120,000 because that's what it was for the past 4 years combined. No, I just have it for this year, $9,500. So what this is saying is for this year only through December 31 of 2000 and whatever year we're in. The other key thing to mention with the income statement is we no longer, and it's really best to prepare these in journal paper like you do your journal entries. It makes your columns real nice and neat. But we no longer have debit and credit columns anymore. We don't column that. What we column are our subtotal and our total columns. So this is no longer considered a debit column, and this is no longer considered a credit column when we're dealing with financial statements. Since in this example I only had one revenue account, that is simply my total, the $9,500. I'm ready then to move down and prepare the expenses portion. And a lot of times I'll put less to show that we definitely do subtract out our expenses. You don't have to put the less, but it's sometimes a good thing to do. If you don't put the less, then you'll definitely want to put this guy here as a negative, either in parentheses or with a negative sign. Because what we want to do is list all of our expenses. Notice here I put them in the subtotal column. Because I want to get a subtotal and then a final running total of our expenses to take away from our revenue. And when we take our expenses away from our revenue, we are left, in this case, with a net loss. I wouldn't even need to put in the word income here. I could just put net loss. And then I put it in parentheses to remind me again that it is a negative number. Revenues minus the expenses gives me a negative number. Now that 6,300, hopefully that rings a bell. When we look back to our closing entries, that 6,300 was our income summary total as well. How much money we had lost in this case throughout the year, and then we closed it out. But that 6,300 is one of our checkpoints. Okay, now we're going to use that 6,300 in our next financial statement. We're now ready for the statement of retained earnings. You can just draw a line on your journal paper. You don't need to start a new journal paper if there is at least a third of a sheet or so left. The statement of retained earnings is not long. It's fairly short. And in effect, the title here takes up almost half of the statement itself. So here we have the proper title, our name of the company, what it is we're preparing, and then notice again we have the as of, which is for this year only, numbers. Now as I come down, you should have the basic format from the notes that we just looked at. But let's look at where these numbers come from. In the total column, again, I got a subtotal and a total column. So this is my subtotal and this is my total column. $7,000 beginning retained earnings. I look back, so these guys, somehow I would mark them on my paper, check them off. I have now used those. I'm now up here. In my beginning or my opening retained earnings balance was $7,000. So that's what I have here. Now my connecting piece was the net income, or in this case, a loss. That $6,300 that we just looked at right here. It gets carried down, that's our connecting piece, as one of this year's adjustments. And then we're going to combine that with all the dividends that we had used and taken out, and we look back, and here's my drawing or dividend account, $4,000. So that's an adjustment that's going to be made to my retained earnings. So total up the change for this year, I went down $10,300. When I compare that to what I started with, a positive $7,000, that leaves me in the negative for my retained earnings balance of $3,300. Remember back to the closing entries. This is the only account where you can have a final balance of a negative, and you could have still done everything correct as we have. The business isn't doing well, but this is the only type of an account where you can have a negative balance, and it doesn't mean you messed up. Like, for example, you wouldn't have a credit to cash as your final balance. That would be a negative. Or you wouldn't have a debit balance on an account payable, because that would be a negative. But with retained earnings, we did, if we look back to our closing entries, we did have a negative final balance of $3,300. So that's our checkpoint. And I match it right here. Now we're ready for the final statement. We have now taken care of all of these items in our first two. The only items left are the rest of the owner's equity and then the liabilities and the assets. So we're ready to take a look at our balance sheet. First thing to bring to your attention, besides the name of the company and what we're doing, is note here for the date, there is no as of. Because with the balance sheet has numbers from all previous years. For example, if I had a vehicle and I've had it for 3 years, that vehicle still shows up on this sheet. So I wouldn't want to say just as of this year I had a vehicle. Well, that's not really true. I've had it for all this time. So what the balance sheet says, when it's just a date, all it's saying is this is a snapshot of the business at this particular point in time. Any prior years are all combined, for example, to get the $30,000 in cash. I didn't necessarily just have $30,000 coming in this year. That's all the years combined. So I want to break down my assets first, and you want to break them down into current and non-current. Our current assets are any assets that we reasonably expect to change, and usually they change frequently throughout the year. We expect them to change, though, at least once throughout the year, if not more than once. So when I'm looking at my adjusted trial balance, these would be considered my current assets, everything above the PPE, the property, plant, and equipment items. Now remember, as I said when we started out, anything that we have more than one of, like AR on my trial balance, for the balance sheet, I want to go ahead and combine them. Because again, the bank doesn't really need to know that K. Smith and T. Jones owes me money. I need to know that. I need to know who to bill. But the bank doesn't care. And it's really none of their business. So I'm just going to combine it and show that I do have $900 coming in that I expect. Same thing with our prepaid accounts. The bank doesn't really care what it is that I've prepaid, whether it be advertising or rent in this case, just that I have services coming to me that I've already paid for. And all of these, we expect these to change at least once throughout the year. Usually more than that, though. Usually maybe even once a month. Okay, so we look at the balance sheet. I've got my cash here. I've got my combined AR of $900, combined prepaid expenses, and my supplies. And I total them up to $32,900. You want to keep these separate because banks or whoever looks at your books, they do like to know current versus non-current. If all of your assets are non-current, that'll put you in a different light compared to having a lot of current assets. These current assets show, in a real brief sense, how likely are you able to pay off your debt quickly. If you have all big items, you're not able to necessarily pay off your debt quickly if you don't have very much in the way of cash or receivables coming in. Next, we want to list our non-current assets. I like to keep them separate. I don't like to net them. I like to keep them separate, keep in this case I only had one PPE item, the car, $25,000 worth. I like to keep it separate so on my books it does show that I have a nice value of something. So if I go to the bank, it doesn't just show a car worth $5,000 if I would combine it. Because then it's hard to know what kind of, the actual value, the type of car it is. Maybe if it only shows $5,000, maybe a junk or beat up, and that may not look as good for the business. So I want to keep it separate and just show that I have used $20,000 worth of the car in my estimates. And then I combine them, get my total non-current. And then one of the key points that I want to look at, and I want to also do, is add up my total assets. Total assets being $37,900. That's going to come important when we look at the other side, the liabilities and the owner's equity. Do they in fact equal $37,900? That's going to be our checkpoint. The other thing is, does this dollar amount equal our adjusted trial balance? The adjusted trial balance shows total assets. Yep, sure does. $37,900. Now, you don't have to skip all these lines. You can just put it right under here, total non-current assets. The reason I did is to compare it real easily, as you'll see in a few minutes, with our liabilities and owner's equity. Okay, we're now ready for the liabilities section. We've only got a couple accounts left that we haven't used, that we haven't checked off of the adjusted trial balance. First up is our liabilities, and with these as well, we're going to want to separate them into current and non-current. Now, our current liabilities are things that we expect to pay off relatively fast, definitely within a year, but usually a lot less than that. Accounts payable, these are just our revolving credits, so we generally pay them off within 30 days, at the most maybe 90. Wages payable, you're going to pay those off real fast. Your employees aren't going to work for you if you don't pay them within the very near future. So we add those up and we got $3,300, and the banks want to know when they look at that, can you easily pay this off with your current assets? And the answer would be yes, we do have plenty of cash sitting there to pay off any debt that would come up. And then we go ahead and list our non-current liabilities. We only had one, so I tried to make this example as kind of easy as possible. So when we total, we get one final now total for our liabilities, the $26,200. And again, I can compare that to my accounting equation, total liabilities. Does it match up? It should. And now the last section, the owner's equity, I'm going to list everything that's left. If I look back to my adjusted trial balance, I've now used all of these, my assets. I've used my liabilities. I've used my drawings and my retained earnings and my expenses. The only thing left is my capital. And now I said I've used my retained earnings, but I've only used this dollar amount, the $7,000. I'm now ready to use my brand new dollar amount that came from my retained earnings statement, the $3,300. So those are the only two items that are left to go in my owner's equity: my capital and my brand new retained earnings ending balance. Remember, that's a negative number, $3,300. Notice drawings are not included because drawings were on the last statement. So when I combine these, 11.7, my final checkpoint, do my liabilities plus owner's equity total what my assets showed as well? And they do, 37.9. Okay, that takes us to the end of the financial statements. Our next video will look at some Wiley Plus problems involving closing entries and possibly financial statements.